This question is relevant with leasing versus buying, which is also called a specific investment decision. Hawker Company is about to replace its existing delivery vehicle with a new design of vehicle that offers greater fuel economy. It estimates that replacing the existing vehicle will save running cost of $2,000 per year. It means it is considered as cash inflow for the company. Option number one is the vehicle could be purchased. It's a buying option of 35,000 by using a bank loan, but this amount is arranged with the help of bank loan. After tax cost of borrowing of 4%, it is already after tax, which means there is no need to deduct tax anymore. But if provided before tax in the question, then first of all, you will deduct the taxation and then you can calculate your present values. The vehicle have a useful life of 4 years and would have a residual value of 14,000 at the end of the period. Straight line tax allowable depreciation is available on the vehicle. In the last, we did written down value, but here we have straight line tax allowable depreciation. Vehicle could be subject to government CO2 emissions tax of $600 at the end of each year of operations. Emission tax expense are corporate taxation tax deductible. Option 2, vehicle could be leased for a period of 4 years for a payment of $6,000. The other option is leasing and constant payment of $6,000 per year payable at the start of each year. Start of each year means first payment will be made in year zero. The lessor will pay the CO2, a tax emission. These payments are corporate tax deductible expense, which means we have tax benefit against the lease installment. H companies after tax cost of capital of 8% and tax rate is 20% and 1 year in arrears. Evaluate whether hawker should lease or borrowing as a source of finance for the new vehicle. So here we will do what here leasing means leasing, borrowing here means buying, that we are buying with the help of long-term loan. So first of all, we will solve these 10 marks and we will calculate either it is financially viable to go for leasing or financially viable to go for buying. So first we are giving the heading of leasing. Years, 4 years starting from year 0, then 1, 2, and 3. Lease installment, 6,000 each year. We have tax 1 year in arrears, so year 4, less tax benefit. Lease installment is cash outflow, that's why tax benefit is deducted. Tax benefit 20% is equal to this multiplied by 0.2 same tax benefit will be available. After tax, lease installment negative 6,000 Then we will say negative 6,000 plus 1200, and same is applicable for next 2 years. And the last one is positive 1200. Now we have tax rate of 4%, sorry, loan rate percentage of 4%. For leasing and buying, both we will follow this 4% per year. We will not use this weighted average cost of capital of 8%. So for leasing and buying, you will always use after tax cost of debt for present value calculation. So present value at 4%, which is after tax. In year zero, we know that present value factor and annuity factor is always 1. In year 1, this divided by 1.04 raised to power year 1. Now I am going to copy and paste this formula in next 2 years. Here we will say raised to power year 2. Here we will say raised to power year 3. And lastly, we will say this divided by 1.04 raised to power year 4. So we have present value at 4%. Finally, we can say NPV of leasing auto sum it is 18,294. This is NPV of leasing. Now we will calculate option of buying. Same starting from years. Purchasing today. In case of buying, basically we will do what? We will make present value of tax saving on capital loans. So we are going to make columns year, written down value, capital allowance, tax saved, 20%, present value at 4%. Tax is payable 1 year in arrears. So starting from year 2, 3, 4, and 5. Here we have straight line tax allowable depreciation. Straight line means what? Straight line capital allowance is equal to, we are purchasing for 34,000. Residual value is what? It is 14,000 divided by what? 4 years. So the constant starting from 34,000, and we have capital allowance of 5,000 every year. Here we have this minus this. If we follow the same formula for next 2 years, and lastly we have what? This minus this, and then deduct the scrap value. It is 14,000. So there is no balancing allowance. There is no balancing charge. Balancing charge means profit where tax is payable. Here we have what? Nil, zero. Now we will calculate tax saving. Tax saving will be same because capital allowance is same for each year. Now calculate present value. Use copy and paste. Raised to power 3, raised to power 4, raised to power 5. So we have present values. If we are going to purchase, there will be a present value of tax saving on capital allowance. But we have other calculations as well, where he says that there is a CO2 tax emission 600 at the end of each year of operation, and it is a tax allowable. Lastly, I will calculate or I will add one more thing, which is present value of this scrap value, because it is also a gain or cash inflow when we are going to purchase. But sales will arise at the end of year 4. So here I use raised to power year 4. So the total benefit is tax saving on capital allowance plus present value of scrap. Now we will calculate the present value of this cost by using this table, years, or we can start from year 0, in which we will show our initial investment 1, 2, 3, 4, and lastly we have 5. First of all, we have initial investment, which is 34,000 negative. CO2 tax 600 less tax 20%, and same is payable in the last year. So now we will calculate after tax. Here we have 600 negative plus 480. And last is positive 120. This one is also negative 600. Now we will calculate what present value at 4%. For year 0, it will remains the same. For year 1, it is divided by 1.04 raised to power 1, and then we will follow this formula. In next year, it is raised to power 2, then raised to power 3, raised to power 4, raised to power 5. Now we will calculate present value of CO2 emissions tax. Lastly, we can do what? We can calculate NPV of buying is equal to this plus this. So NPV of buying is 20,301. On the other hand, NPV of leasing is negative 18,294. Leasing is cheaper, so we can suggest that what can we do? We can go for, or we should go for leasing. Leasing is cheaper than buying, so we should go for leasing. Next one is discuss two factors, two reasons other than the possible after-tax cost advantage why each company may choose lease rather than buying a new vehicle. Leasing gives an opportunity to acquire a new equipment at the start of next year if available in the market. Number 2, no significant cash flow is needed to acquire no significant cash flow is immediately needed immediately to acquire a new non-current asset. If Leasing is renewable at the start of each year. Then there is flexibility to terminate the contract during the lease term. So these are the factors. Discuss three advantages of using NPV rather IRR in investment appraisal. Okay. First one is NPV is a decision rule, which means decision is made on positive NPV rather IRR. If NPV is positive, then we will make investment in project. Second one is NPV is based on present value of cash flows, which considers time value of money, so it gives more easily understandable and reliable picture of the project. Next one is IRR is given in percentage terms, which is also called relative terms, but NPV is determined in absolute terms, which are close to, not close to, which are aligned with the objective of wealth maximization of organization. So these are the reasons.